Thank you, Mr. Chair. Bipartisan concerns continue to be expressed about the long debt proposal, as we've heard numerous times this morning. It's important that regional banks have the same flexibility as global banks to hold debt at the holding company level, rather than requiring them to hold it at both the institution and holding company. Mr. Gould and Mr. Benston, would you agree the regulators should not move forward on the rule until key changes have been made and the Basel framework has been finalized and implemented?
Yes, I agree. If the agencies are going to move forward with long-term debt, if at all, and if ever, then they should absolutely not do so until Basel III has been finalized.
Yeah, Congressman, completely agree with that, as well as your point about where the debt should be held versus, the IDI or the holdco. And I think that doesn't. I think the agencies need to look, and these banks are not monolithic. These institutions are different. They have different business models and how they operate, and the proposal doesn't take that into consideration.
And as you gentlemen know, community banks often rely on brokered deposits to manage liquidity. And stricter rules may limit their ability to compete with the larger institutions. Again, something that was mentioned this morning. Reducing access to brokered deposits could limit a community bank's capacity to lend, potentially stifling growth in, obviously, local economies. Mr. Gould, are you concerned about potential reduction in liquidity options for community banks if the brokered deposit rules are implemented?
Yes, I am. In fact, the rule actually seems likely to possibly decrease the safety and soundness of banks and actually acts in a pro-cyclical way rather than counter-cyclical, which most bank regulation is designed to do.
Mr. Benston, could you just discuss briefly, if you could, or some of your thoughts on this proposal? How would it potentially limit options for retail investors?
So the broker deposit proposal that's been put out would redo a 2020 broker deposits rule, and it's done without any quantitative analysis. It's really putting the cart before the horse here. And with respect to the brokerage industry, wealth management business, about 70% of cash, average daily volume of retail businesses in cash and sweep, what's known as sweep accounts, is moving between investments that retail investors have. This would effectively raise the cost on that, and it applies to both non-affiliated broker-dealers and bank-affiliated broker-dealers. So this rule is very problematic in changing the rules of the game, and we're not sure why the FDIC is doing this to impact sweep accounts, and so we're eager to find out why. But they really should do an analysis before they put out a proposal like this.
Thank you. We've discussed some of the changes that Vice Chair Barr recently outlined to the Basel III Endgame proposal. However, it appears the re-proposal would still require banks to hold capital against fee and commission income as a proxy for operational risk. So I'm just thinking, under the proposal, a Wisconsin manufacturer trying to ship products internationally would need to pay more to get a bank letter of credit in order to facilitate those shipments, ultimately leading to higher costs or reduced availability for the products. This would obviously raise costs for local governments, businesses, manufacturers, farmers, and others who use the banks and the capital markets to borrow and to grow and to hedge risk. Mr. Benson, while we don't have all the details of the re-proposal, how do you anticipate higher capital requirements for market-making activities to affect the liquidity in the capital markets?
Well, with respect to the operational risk, we're encouraged by what Vice Chair Barr said about that, exactly to your point, that they would allow certain deductions or credits with respect to fee-based income, which is something that actually was I think in the past, a policy view that banks should be engaging in more fee-based activities. And so we'll see what's in the final report there. I think beyond that, I would point out, if you think about in the case of Wisconsin, or you think of Oshkosh, or you think about GE medical equipment, which I think is still part of GE out there, a lot of that equipment is financed through the securitization markets. And it's an ability to have a steady flow of capital for those activities and lending, as well as for banks to offload and manage their risk. Again, the Basel proposal, as it's calibrated, is very punitive towards that, would have a knock-on effect to those companies. So we hope that they've taken those into consideration, but again, we'll have to see the detail.
Thank you, Chair. I yield back.